Hi, welcome to the Froggy Five. I'm your host, Jim Freilich, founder and managing partner of Froggy Companies, and happy today to be joined by Jon Weiskopf. He is the founder of Blue Eyed Capital, where he oversees acquisitions, asset management, investor relations, and he does all that based on the foundation of a 20-plus year career as an engineer, where he did, among other exciting things that we might get into, where he led Apple's worldwide engineering team for retail real estate. And another thing I'm excited to talk to Jon about that we share in common, but sort of from different angles right now, I think, and that is the idea of fostering environments where future generations can thrive, anchored in sustainability and ethical practices. So I'm happy to get into this with you. Thank you for taking the time out of your day to join us.
Yeah, Jim, I'm excited. I'm really looking forward to talking. I can't wait to learn stuff from you. So this is great. I'm happy to be here.
Yeah. So to start at the beginning, tell me how you got involved in real estate and kind of what makes you tick with this.
Sure. Actually, by chance, not by purpose. I went to college at Lehigh University out in Pennsylvania, and I wanted to be a race car engineer. I wanted to design race cars and drive race cars for Ferrari. That was my dream. Graduated college, didn't want to work, and took my first job interview at a MEP firm, and from a friend's dad. And I started designing HVAC systems, and my career kind of took off from there. I spent the next 20 years leading MEP teams and designing mechanical, electrical, plumbing, all that, building systems for commercial real estate. And as you mentioned, I worked for Apple for about 9 or 10 years. And I was in charge of every store, the engineering that went into every store that they built over that period. So it was a great venture, and I got to travel all around the world, and I've built in, I think, 20 plus countries now. And, I came to a point in my career where now I became a dad. I'm a dad to a 4-year-old boy. He is my Blue Eyed of Blue Eyed Capital, so he's why I'm
Nice.
here. And I wasn't doing enough, I think, Jim. And I know a lot of people say that, but for me, I felt that I had a skill and an opportunity to bring something to the real estate world that wasn't there today, or not least in the masses. And so I quit. I quit Apple. I left it behind. I wanted to stop building somebody else's dream. And, I see a need for me to provide my son not just maybe wealth and growth and the opportunity to give him anything that he needs, but the world has to be there to be able to allow him to thrive. And I think we're going to talk a little bit about that community building and why I think it's so important for my son and just the future of the humanity.
That is great. That's outstanding. I'd love to hear the why in this case, because you're extremely motivated in a really important way. Not just from the money side and the passive income side, which is what initially drove me to real estate and a lot of people. But when you get into it and look at the wide world of real estate, you realize there's so many different areas you could get it into. That's what has excited me as a second career, also as an engineer with a 25-year career before that. The idea of making tangible changes. That's the other thing I think. Well, now you did some more tangible engineering than me. A lot of my systems engineering was overseeing government work, like large government contractors. And then I did other analytical work that was more military mission focused. But I would say I used to make jokes about being an imaginary engineer, right? I had an industrial and systems engineering background, but we work on these long projects, and sometimes you see them come to fruition, like ground stations for unmanned vehicles. But a lot of times you can work 2 years and not see anything tangible. Whereas here, you can see stuff every day. You know what I mean?
Yeah.
It's good. It can be nerve wracking at times, right? You're seeing it happen right away, but I guess from one thing you can leave your son too with that other background is elegant solutions, right? You guys, Apple was all about creating elegant solutions. I'm sure you're probably applying some of that in your practice already.
I wish I had the bank accounts that Apple gave me when I was there to do what I want to do. Apple didn't always do things that had a return on investment or a need for return on investment. Their definition was different. And some of their needs. So that's probably been one of the biggest adjustments to my world. 10 years of living one or working and operating one way, and then switching to a world where, everything needs to have a return on investment. I mean, I'm looking for money from outside investors to help me, do this work, right? And so, I think that's the challenge today, is showing individuals that sometimes the work is necessary. It's not going to have a direct financial return on investment, but that doesn't mean that it's not helping your financials.
Sure.
Right?
Sure. So you can't just turn around today and get the R&D department on that. Cut me a check, right? You're like, what? That costs how much? Okay, yeah. Well, you find yourself pinching pennies more.
A little bit more now.
During all those checks.
Yeah.
And I can tell you for sure. Yeah. I haven't been a guy. Yeah. Whatever. I was an Air Force officer, or then even as a consultant, it's like we were playing with monopoly money. So every time we tried to bring something to, say, even counterterrorism work, the Department of Homeland Security, once I won a task from them, and I put this team together. And one of the things was really about like return on investment. Like, I don't know how you weigh that return on investment. These people didn't get killed today, or these were safer. Like, but I mean, like, you can't use regular market thing. We're using monopoly money over here.
Yeah.
So I can't use regular metrics of like, did that, was that worth it? I don't know.
But you know what, Jim, I bet you that it makes you think a little bit differently when you think about what return on investment means. And to me, entering the real estate space, the ownership side of it, right? And I focus on multifamily and mobile home parks, but getting into that, most individuals' return on investment is strictly financial. And one of my goals in what I'm doing with Blue Eyed Capital, I want to prove that that's not the only metric that actually produces financial returns.
Yeah,
I think people are leaving stuff on the table.
That's a good point. And there are a lot more investors becoming, I guess, ESG score minded. I'm not a huge fan of ESG scores.
I don't like ESG
for other reasons, but yeah, you do have people that will. There's a good book called the China Coming Wars. I think it's over a decade ago. I read it, and it was really about sort of competing with manipulation of dollars and labor markets and things like that. And one of the key points in it was, I think they did a test. I'll probably get this wrong. Maybe it wasn't Walmart, but basically you could take two pairs of socks and you could put them side by side, maybe at Walmart or something. You could say this one's a dime more expensive than this one, but this one was done under fair trade, wasn't slave labor. And inevitably, most people start still taking the cheaper socks. So you have that same challenge in this environment where you have your ideals and you come to the equation. Like my initial one was safer, cleaner, friendlier living. And I would take things from D class and make them C class, or C class and make them B class. And you have one on the investor side. You have to deal with that. So hopefully you can at least be at the same level, and then give them an option like, if you're counting on 12% or 14%, you can get that, or maybe you'll take 13 instead of 14 if you can do all this good right here with what we're doing as well. But ideally you could do both, right? You could compete. It's a tough equation, I'll just say.
I think you can do both. I just see that what we're realizing is that in order to do both, you really need more time. But I think that time and that longer game, a lot of multifamily stuff out there, 3 to 5 years. And, my opinion of that is it works. It's not that it doesn't work if it's done with the right folks. But a lot of it is because most individuals aren't really investing in the actual asset. Mm-hmm. They're investing in the business that owns a piece of property. And they're trying to spruce up the property from a cosmetic or a lipstick perspective. And then that stuff wears off and they're ready to give it back because they don't want to own it. They don't want to operate it. Right. I spent 20 years doing the buildings. That's all I know. That was my career. And I did fairly good at it. And so long-term ownership is where I think the value's at. And it's not just in the market fluctuations, but it's what you can actually do. And it's those lives that you can change. And if you can change people's lives, and I think that takes time, that's not overnight. It's not like knocking down a wall and putting a new wall up. You can see that instantaneously, right? It's simple. But changing somebody's lives, and that's by offering them more, giving them stuff, giving them resources that they never had access to. That takes time for them to change. But when that change happens, that change is significant. And I have this little term, spiral compounding, right? Like that effect impacting a human that effect goes outward. It's not just them that actually become impacted. They're going to impact somebody else. If you can transformatively impact one person, that person does it again, and that will just keep going. And that, to me, that is the value here that I am hoping and trying to tackle or tap into. Because that, to me, is real change. I don't focus on ESG. I think carbon neutral is a great thing for big companies and people that have the funds to do it. I don't think our world is going to get there anytime soon. And so I'm not here to promote net zero. That's not what my business does. What I want to do is I want to promote different changes and smaller incremental changes in how you operate buildings, how you focus on things, and how that operations can be transformative to the individuals, and how those small changes, every building that does 10, 15, 20% better is better than one or two buildings that are built to this crazy, amazing, net zero, never going to fall down, going to live forever type of score. That's just me, right? I want to do good, but I think it's doing good with the masses more. So,
yeah. There's there's a lot we can get into. We'll have a whole separate discussion probably offline about that, because we're looking at passive housing and affordable passive housing. And, I have my own private, because I read this book about microplastics. I have a private war against microplastics, but try taking plastic out of your life and see how hard that is. It's hard. But every little bit counts in terms of what you are trying, what you're trying to achieve. Being thoughtful about it as you head into the project and being able to do ground up or rehabbing a place from scratch helps. But I'm gonna shift gears. I'm gonna come back to that in a few minutes. But now I want to ask you. So I want to get a few thoughts from you on how you're using technology today, either how you're using it within your own business model, either something what you guys are using, or where you think the industry is heading and where some exciting prospects are.
Sure. I'm going to do two different types of technology because I think they're both going to be, they're both needed. So I think the first one is the more simple and kind of probably more mainstream that's out there, though it's very segmented out there, is data. All right. Data is the only way to operate something. And I think that's the key to asset management that a lot of asset management or asset managers in today's real estate world and ownership don't follow enough. The big people, the big players have Appfolio, have Yardi Matrix, have all these property management softwares that they can spend and pay money for, and they're tracking data. Mm-hmm. Are you using it? That's the next piece in technology, right? Are you using that data to actually produce an outcome? And you have to be good at it. You have to understand what to track. You have to understand how to track it, how to read it. But that is what we're trying to do. And we find it so incredibly important for us, because really what we're trying to do is we created an impact scorecard for impact investing. And we are trying to prove out that what we're doing is working. We're doing it for two reasons. One, for our own investors. Are we doing the right thing? Are we using money the right way? Two, is what we're doing actually helping the people we're trying to help? The only way to do that is data. And, the only unfortunate piece of all that is, since I'm newer into the game, I have to build that database. So it's going to take us some time to really, really get that set up. But we're setting up and scaling up those programs to track that. We use data tags, we use KPIs, we use graphs and metric, all of that stuff to track and report on. But I think that's mainstream, Jim, but maybe not mainstream enough across the majority of property owners. And I think the more and more people that can see the value of that, this goes back to just regular bookkeeping, right? From having stuff electronically, right? How important it can be. The next piece that excites me a lot is tiny home and more modular type construction, offsite construction. And, I know there's a battle out there between locally sourced materials and doing things with local labor. I live in a very small town, 10,000 people. There's only a handful of home developers up here, but we have a massive demand for affordable housing in just this small town. Service individuals that make $15 an hour do not have homes or apartments to live in. Any home that comes on the market, There was a fourplex that came on the market on Friday. I went to put an offer on Saturday and I was late. Right? This stuff gets scooped up fast and I'm actually looking for it. But I think mobile or modular technology, or modular construction, offsite construction is one of the only ways that we are going to truly combat the affordability issue. Because part of the affordability issue goes down to just lack of supply, lack of availability, which maintains cost. I mean, I think the average cost of a home in my town that they deem that my county is helping offset taxes for them as affordable, $300,000 homes. That's not affordable.
No.
So those are the two technology pieces that get me excited, and I still think are underutilized today.
I agree. We're neck deep in both of those areas, having done modular projects and dealt with the challenges out in Western Colorado, where the AMI affordable was going to be $400,000 small homes. $400 to $500 per square feet was affordable. Apparently, that ended up being $600 to $700 per square foot, and the market could absorb them. And with the particular project I'm thinking about, originally Champion Homes was going to build them, and it turned out that what needed to be done on site turned out to be so much more as we built on, and we started looking at different modular companies and looking at different automated companies that the cost just went going up. They kept going up. And then the other thing in certain areas like that, so I won't name any certain towns, but you go to towns that say they want affordable housing, and then you go to planning and you go to town council, you get it under contract, and then you're actually building it. And then a lot of other stuff, impact fees, rules, and it's like, do they really want affordable housing, or do they want one, a lot of fees coming in from the developer sometimes looks like a cash cow coming in, I think, to some towns. But the other thing is people being honest with themselves about their commitment to affordable housing. So that can be a challenge. But so I've seen the modular versus stick and tiny homes as well. So we're trying to figure that one out as well. And locally sourced. We are working on something. We have a dream of locally sourced and affordable to bring trades back to certain areas. But it's such a long-term thing that I think my son and I have been talking about this. And he's out swinging a hammer today. He's saying, in the interim, you have to do some type of modular. You probably have to do modular to get there, right? Because outside of having those supplies locally and having the trades locally or in enough shooting distance, then you're stuck in that area where, what do you do?
It's speed. I mean, I have this, I have not proven this out yet, so I'm going to share with you. I have this dream of a target of a 1,000 square foot, or roughly 1,000 square foot for 150,000, all in. Land, services, everything, home, ready to go, turnkey for 150,000. If we can get to that point, I think we open up the door to a lot of people from both a purchase, but also from a rentable perspective, right? Built to rent type thing. The reason why I'm really gung-ho about it, and again, I don't think we have all the services or the manufacturing in the United States yet, but the reason why I like it is from an investment perspective, it is the fastest way to market, I think. Right? Building off-site is more controllable from a cost perspective and from a finish and material product, end product perspective, right? Quality control. But then also, I can be building while I'm developing land, while I'm laying foundations, while I'm bringing in utilities. And, we're looking for people, and we're still out there searching, but we're looking for people that can build these 900,000 square foot, modular homes for, in under 6 months. And with site development, and this is like the good site development where it's already kind of flat land. I don't have to move a lot of stuff around. I'm more just kind of grazing and padding and bringing, water, sewer, telephone or power and stuff like that there. But I just see it from a speed perspective. It takes too long to go planning these big apartments. It takes too long to get all this planning. So, that's what we're trying to do. I'm not there yet, Jim. I'm far away from it, but I can also tell you that the problem's not going to go away. So don't give up.
It certainly isn't. Yeah, the infrastructure is a challenge, right? You look at piece of land's price have been so expensive here in New Hampshire. I like to say, we've passed up on projects where the land seemed like a really good basis for some kind of multifamily, and then after using the numbers, analyzing the data as us engineers do, we're like, okay, we can't do this. Even if this land is free, we couldn't do this project because the infrastructure we have to bring it in for is not going to help. Now, I grew up in South Florida. I grew up in a trailer park, and down there, like setting up those subdivisions, that's like the cheapest infrastructure you could do in flat areas with short driveways, it's just, but every geography has to have a way to get affordable housing. So figuring out, I think the gray water systems and septic designs and the codes, I think the evolution of codes relative to what could get you towards net zero based on systems is a very key important part of that, because like we have some partners and they're actually doing some developmental housing. They were experimental out in New Mexico for like 10 years, where based on the type of heating they use, the type of design in the walls, they use those, what I don't like, the styrofoam walls or whatever you call them. I forget the name of those panels. They've been around forever, the SIP panels, right? Mm-hmm. That are inside the walls. But the key to their overall system is in the house that wouldn't vary 7 degrees without any systems on, whether it's 100 degrees outside or 0 degrees. Wow. Is a big part of it, besides the radiant type of heating, is the gray water system inside and attached to fire sprinklers, which lots of times you would think we don't need sprinkler system in this subdivision. But if you do it with these new emerging technologies, there's a possibility of shortening the infrastructure needs, because the fire trucks won't have to go as far because every house has a sprinkler, or the code guy goes, oh, we've never really thought about this gray water system, but you're reutilizing water that's been captured in here in a different way. I think all those things tie into some way, make it more affordable housing. But 150,000 square feet. That's
my goal.
I'm with
that's
you on
my
that.
goal.
And the building
I'm going after it.
Let me ask you this. What do you think about this? Because we've talked about this as well with build-to-rent communities. What do you think about lease to own? What do you think about starting something build to rent and
100%
lease to own? Because I want to give people a chance to own that thing someday, right?
Yeah.
Have you guys done anything with that, or are you just thinking about it? Or?
100%, and I think that goes along with it, right? But so yes, I should have said that when I said build to rent too. It built to own, all of those. I think giving people something that they can have that's going to last, is valuable. And provide somebody some equity if they decide to move and whatnot. So yes, I support 100%.
Yeah, there's a whole. So I won't go down the potential social engineering obstacles with that too, because when you have cheap rentals, just the natural challenge you have is dealing with humans, right? So and some humans come in, and not everybody wants to take care of stuff the same way. It's nice to say, treat it like it's your own, but not everybody will treat it like its own. And some people don't treat their own stuff very well. So you're like, okay, there's got to be a middle ground here. And I think there are methods that people are using. And I'll say the Roots guys in Atlanta, if you're not familiar with them, Roots Investing, they've got a pretty good model going on there that we can all
mobile homes. Learn. Is that mobile homes, Roots?
Invest with Roots. No, it's really they're flipping houses, flipping affordable housing. And they're tokenizing it. There's a REIT built around it. And Larry Dorfman is the guy I know there, but his son and another guy I think started that business. But it's very interesting in terms of how the people living in the places can invest in a fraction of it. They can get certain rebates based on treating stuff the right way, treating it like their own. And then there's also an app they have called Bloom that they use in apartments, where people go through and take video. It's kind of like what you use when you're moving in and out for your checklist of everything's all right. But if they do it on a certain regularity, they get some type of money back, basically, for, it's a way that they can collect data on how's the refrigerator, how's the stove, so you're kind of doing
Like
a
that.
systems check at the same time. It's
Both.
really, it's a little innovative. And I think it's, the type of thing that's also needed because, because whether anybody wants to say it or not, you want to have people treating things the right way and living as a community, because that's part of the fostering the environments where people can thrive is a safe community where everybody's kind of on the same page. And I think having communities that are rentals to begin with, but sort of people earn their way into buying those, both monetarily, but also through treating the community and their neighbors in the right way, I think could lead to a good future for these communities that start as rentals.
Yeah,
Yeah,
you
that's
know what, Jim,
my thought.
and you know what I hear in what you say too in that program is, in my belief, some of this is about re-educating, right? I think a lot of individuals in this that live in C-class properties that are more on the lower income spectrum, they haven't always been given something to respect. They haven't been always treated in the right way. And, you go rent a Class A property, nothing's ever broken, right? Or things are maintained. And that's so somebody else is always sees maintained. They want to maintain something themselves. You go to a different type of property, and I know most landlords out there are constantly trying to, maintain their properties. But if you're showing if you're giving somebody something that they can respect, then you're also teaching them that the value of respect will ultimately help you, right? And goes a long way to your pocketbook and things like that. That's what I think part of this mission is. Part of our jobs to do as owners of these properties is to educate and teach and reward. And if it takes a little bit of money off the table, but it saves me money in the end, I'm taking notes while you're talking about some of this stuff.
Yeah.
But I do believe
We'll
it's
come
an
back to that.
education, right? I really do. And I
Yeah.
think it's these individuals deserve that education, but they have to understand what it gets them, because I don't think they've always been taught that.
Yeah, well, that's why I mentioned the social engineering aspect. But there's a whole other can of worms you could get into there. But I've lived it from every angle, right? I had the privilege of growing up in a rough neighborhood, and I call it the privilege because it helped me be a stronger person in life. But on the flip side of it, I've had my wife's managing property. See, I'm not a good property manager. I will not manage any properties myself. I don't picture myself doing that again. But I've gotten in these situations. My wife, brand new rehabbed 2-family, and my wife's got a big heart, and she rents it out to someone, and we turned out that the boyfriend's an ex-felon and he's into meth, and I'm taking down wires that pit bulls are running on, and and then they want to pay the money up front, and then I'm 6 months later changing the locks while the sheriff's there to make sure they leave, and I'm helping move furniture and you run into these situations.
It's hard.
So the re-education, if they're younger people, maybe if they're older, there's got to be a track record. You got to check in. So there's a balance there. It's not an easy equation, but I could give my warning on that. I'm going to lead that into segue into my question to you about, now that you've got a certain body of work under your belt, what's a good warning you can give our listeners of something that's gone wrong, or something you've learned the hard way and now you've corrected in your business?
So due diligence, you can never do it good enough.
I hear that one a lot.
I mean, man, I have a property now. We missed something, big, and we got a couple $100,000 worth of stuff we have to figure out how to pay for. And it's don't discount due diligence. Don't trust other people's information that to give you. You need to verify it, even if they believe and they claim that they're professionals. So that's the biggest thing, due diligence, because you can't undo that. You can't undo a property. You can't take back something that you missed. That it doesn't work that way. And I think, having a rainy day fund. It sounds silly. You might think you've got everything covered, but you got everything covered until you don't. The one thing I learned from Apple is, we look 10 years down, 20 years down. And I try to look at and approach my business as how can I fail? How am I going to fail? What is going to fail my business if I buy this, if I miss this, right? It's not where my successes are going to come by, because those, if I avoid my failures, I'm going to succeed. So we like to look at how am I going to fail, and how do I avoid this, and how do I mitigate my risk against these? And but there's always something you might miss, and so be prepared. Right? How are you preparing yourself for these things? So that's not, using every dollar you have. That's not, looking to the next day. Be proactive, not reactive. You have to train property managers. They need to tell you what's coming, not what came. If it came already, you already owe a bill. If it's coming, you have a chance to maybe figure out if that bill is going to be 10 grand or 5 grand. Or if you can do it more efficiently, you can do it a different way. So I think teaching proactivity is a skill that many, many, many don't learn and aren't taught. And most individuals, most businesses operate reactively to their day-to-day business. And that is not going to keep you in the black.
That is great insight. So on that front, so in terms of forecasting, or trying to think to my last, I don't want to use everything in military terms, but like war gaming, blind spot planning, like blind spot analysis. It sounds like you've had some of that and done some of that type of analysis before. Do you integrate anything specifically, or is it just straight up sort of common sense analysis of like, okay, let's have a contingency fund, let's look forward? Or do you implement any kind of either time boxes or tools that help you either forecast what's happening physically with assets, or sort of imagine those failures?
Sure. We use unit. So I'll give just one example, right? So we have a unit tractor for our properties, and in that we track carpets, flooring, whether it's carpet, vinyl, when was the date that it was put in, our appliances, air conditioning, heating units, what are the dates of those? And so really looking at what are the dates of these things, what is the expected life expectancy of them, and when is it going to hit me? I have one property, it's 64 units. It's a low income housing tax property, Section 8. And we bought it a year and a half ago. We have renovated 36 of the 64 units and heavily turned another, 20 of them at least. Evictions cause people to leave damage. And we've had to read it. But what we're doing now is, okay, how long can we expect this floor to last? And is it going to run up before the next lease? And if it is, when is that lease? Do we have money ready to go? Because we might have 5 units coming up for lease. Now, I'm lucky and unlucky. We've just upgraded a lot of those units. So we don't have a lot to plan for anymore, but we still look, right? We are still looking. What if I don't sell that property in 5 years? Because I can't, because the market's not right, and I have to own it for 7, right? Thinking that I'm going to pass it off to the next person is not the right place. It's not the way to be prepared. I think the other thing that I do, Jim, is, and this is just the engineer in me, I look at opportunity cost. So take air conditioning for a reason. I think air conditioning is the one expense that most owners never want to incur, and they will push off as long as possible. That's great. One way of doing it, not the way I like to do it. If I replace an air conditioning unit today, my opportunity costs are not just in what the cost of utilities are on today, but they are in the cost of how fast are utilities rising. I don't own anything in Tulsa, Oklahoma yet, but I love that market, and I watch the data in that market. Last year, Tulsa's utilities went up 20%, or 19, sorry. It's like 19 point something. Wow. That is huge. A new air conditioning unit today versus an old one versus 19% increases in electricity, that changes the payback of that cost, of that spend.
Yeah.
And if you look at it that way, right, if you reevaluate how you analyze some of what you're spending and why you're spending it, and I'm sure there's going to be people that are going to listen to this and going to say, well, I pass down all my utility costs to my tenants, my residents. Sure. Okay. But if they're living paycheck to paycheck and they just saw a 20% increase in their utilities, who's getting paid? Who are they paying first? You or the utility company?
Yeah.
And are your rents going to be impacted because of that? Right? Rents are market driven. Rents are not controlled by you. I as an owner, I as a property manager, right, or the owner of that property, I have the better ability to control expenses than I do income.
Yeah.
And so we really focus on, right? We really focus on income. And it's also, look at solar, right? I don't have any properties with solar today. We're still evaluating some of them and seeing how financially feasible it is. But again, look at utilities. If today's cost is going to take me 7 years to pay back solar, what if utilities keep going up? If I'm using solar to charge my tenants for power, well, my value of that, my return on investment of that keeps going up year over year as utilities go up.
I want to ask you now about a deal that you've been psyched about. It could be something you've already done or finished. It doesn't have to be the most profitable deal, but like, what is there's some method you guys just hit it out of the park and you're super happy about it?
Well, I'm actually going to talk about one that I have that we are actively, raising capital for, and it's something that we're psyched about because I think it's trying to change the game, the name of the game. And I mentioned earlier in our chat about long term, and we are launching have launched and are currently under the capital raising. It is a 506c opportunity, so only for accredited folks, but. We are trying to build portfolios, right? And so our fund is a long-term fund. We are seeking to invest only in mobile home parks. And we're looking to bring investor capital in, a one-time investment that over the next 5 years will build a portfolio of 2 to 3 mobile home parks that we want to then, at 5 years, return our investor capital, but hang on to these parks for another 10 to 20 years, right? And the reason why we're doing this, the reason why we're taking this approach, and we know it's different from the market today. Most individuals want all their money and all their bang and all their buck, in 3 to 5 and double, triple my equity and give me this big tax bill and all this stuff. We don't believe that's the right way and the right game to play. So we are looking to use investor funds and our own, teamed with our own, to build this portfolio of parks that then produces infinite returns after we give capital back, initial capital back, and use it to build the cash flow machine that builds this portfolio for the long term. And we think that the value of the long term is also with our impact investing. And so we're using this fund to test out our impact scorecard to really go out there and measure this stuff, Jim, right? I said it. Are we actually doing what we said we're going to do? And that to us takes time, but it also takes time to build a portfolio, build a strong portfolio that weathers the market. Look at us today. We're in I don't want to say a bad market, but we're in a market that a lot of people didn't anticipate. Maybe you should, maybe you shouldn't have. But whether you got it right or wrong, right? There's no timing in any market. We want to build this long-term, stable fund that we believe just is what real estate is all about. We're not in the flip game. We're not in the put lipstick on a pig game. It is called the Impact Growth Fund 1, and it was with a good partner of mine from a company called Wine Mountain Capital, and we are 2 individuals or 2 groups of businesses that are adamant that putting people first will produce the best profits over the long term. And we live by a motto: healthy home, healthy person, healthy planet. Right? Through our work to give people healthy homes, you create healthy people that ultimately have a healthy planet. And this isn't about sustainability, but this is about humanity. Right? This is lifting up every single individual out there for the betterment of all of us, not just the home community, not just us as investors, but the world at large. So it's something I'm extremely psyched about. We've just launched it out, and we're really, like I said, we're hoping to change the world out there and really change the game of investing. Right? We believe that investors should deserve and should ask and expect more for their money, not just financials.
I like it. My mentor, I guess you would call him, and my partner on deals, my primary partner, John Bogdasarian, wrote a book called "Do the Work Once, Get Paid Forever." So it works right in there. Like
That's it.
and
That's
it's
it.
funny
I like
if you can
that.
do it. I mean, yeah, you should grab that book sometime. It's short, but it's a good read. He's pretty funny. But I think that makes perfect sense. So you want this fund is something that investors can be proud of. A, B, they're in it. They're in it for the long term. It's like, hey, I'm part owner of this park, and everybody's taking pride in their continuing assets, and you keep growing. So it makes perfect sense. So thanks for bringing that up. That's
Thank you.
motivational to look at. And I think we'll have to wrap up here soon, but I want to pick your brain on one other area, and it is related to financing. And it's a hard subject for some, not people that have been in real estate for like 30, 40 years. Like what's happening with interest rates doesn't bother them at all, right? People that can hold on to real estate long term, they're not phased. 7.5% is like nothing, right? When I bought my home in the late 90s, I was in that category that should have been part of the burst, right? Like I had no money, almost no money down. I had 10% loan. Like that was not a big deal, but everybody got so spoiled to these artificially reduced interest rates. Now a lot of people are panicking. I'm wondering in your world and what you're doing, how you deal with debt or creative financing, something you can share with listeners, some type of wisdom or challenge,
Yeah, sure.
financing.
Outside of my fund today, I'm actually buying an assisted living facility with another partner of mine. And, it's 12.15 million is our purchase for this facility. It's out in Florida.
Mm-hmm.
And in order for us to purchase it, we had to get creative. So we have, let's see, I think 3 million of seller finance for us. And that is coming in at, I think it's about 6%. We got the owner to agree to. And then the rest of it, the other 7 million, then we got about 2 million of our own capital going in, maybe a little bit more than 2 million. And then the other remaining 9 million is a fixed debt at 8.6, somewhere around there. 8.7% is our loan. And people might think 8%, oh my gosh, how are you paying for it? But look, we're buying an asset that is cash flowing. So this is a great business. It's cash flowing. It's a 114 bed assisted living facility. And so how do I deal with it? I make sure the numbers work. And if they don't, I don't put in a bid and I don't try to buy the property. I don't try to over leverage myself. So, it's a little bit high, the debt's a little bit higher that we were hoping for. But we cash flow. It's a great property. And our business model is, we believe the facility has been kind of not operated on the most cost-effective manner. And so we believe that we have room to reduce expenses. And by doing that, we believe there's untapped value. The property is actually appraised at 12.9. So we already have some inherent equity from our purchase price, but we're looking to boost that. And then we're going to refinance next year, if all goes well, and convert to a HUD loan, which we're already getting, which we believe is projected around 5.6%. So I think you have to be creative. And, sometimes maybe the word creative it's not about creative, but it's just being intelligent with, do these numbers work and does it pan out for me and my investors? The answer in this one is yes. We actually even have prepayment penalties on this one, Jim, that we're going to pay and we're still going to make money out of it. And it's okay for us. Exactly. But we did the math, right? The math is telling us that it's okay to pay 4% prepayment penalty because we had bridge debt at 12%. And if we don't get it and we miss our mark on a refinance, well, we have a spread there. And so I think it's more about, you said it, some people in the seasoned individuals on these aren't panicked because they do the math. And they don't put all their eggs into a 3% loan. And if it goes to 6, I'm screwed. But I still have variable debt, so it could go to 6. all of our stuff, we do fixed debt only, and we do fixed debt because it means that we know what we're getting. Even if it's 6, 7, 8, 9, 10, 15, whatever it is, I still know, so I can do the math, right? I can tell myself.
Yeah, so you guys have, and so you're happy with a cash on cash return from that right out of the gate, or you got to wait a year to cash on cash, and do you have investors in that as well?
We have private investors, so it's a very small thing. Very little investor money. Most of it is our own. Most of it's our own equity. And cash flow is not our play year one. We will be cash flowing. We actually have a good cushion, but that's not our buy. Our buy here is very untapped operational cost reductions, and moving this and taking the time. We have to put some CapEx into the property to make it qualify for HUD. It's not fully ADA compliant at the moment. That's, American Disability Act. So, accessibility and things like that. So we have some money to put into it to get HUD qualified. And we know and pretty confident that we can do that in, 12 to 18 months. But cash flow is not our play on this one, year one. But once we're due, we'll be cash flowing beautifully.
Will you be, well, two questions. One, with that facility, you plan on holding on to that, like the mobile home parks as well?
We are looking at a more shorter term hold.
Oh, okay. And the HUD for an assisted living facility, is that same as multifamily? Like, is it like 223F, or do you know what kind of HUD loan it is?
Yes, it is. It is very similar. And one of the great things about HUD is HUD loves assisted living facilities. So from qualifying for these loans and getting these loans, a assisted living facility fits right into what HUD wants. And there actually is a lot of intrinsic value in getting a HUD loan because it does take time and you have to prove out your model. And so it's actually a financial benefit for us to get into that loan. And the beauty of it is 35-year amortization schedule.
What I wanted to ask you about with that was because we almost invested in $32 million in 2 different ground up assisted living facilities just before COVID hit, like March of 2020. And so, and it raised the capital, and it was like, put the skids on it, right? And doing all the underwriting of that, I learned so much about that business, and we had an operator, one of the top 10 operators in the country lined up to do that because it's a whole other business. So I'm really just curious, are you guys going to manage this yourself, or you already have an existing senior living facility type operator? Are you diving into the operations?
So we're diving in a bit, but the business that we're buying is a family-owned business currently, and so we have an agreement with the seller, who is the family, to stay on with us for 1 year to help us learn the ropes, and we are maintaining 100% of the staff to continue operations as is.
Oh, nice, good.
So, and my part, we're a little bit lucky. My partner that I'm buying the facility with, his wife is a medical billing expert. Which gives us a little bit of a leg up in there. But a lot of it is, my partner is the strong man in this. And by what I mean by strong man is he is a people person. And so he's really found we found an opportunity, we found a business to buy with strong people. And so that is really who we're buying into, is the business and the people that have been operating it. And they've been there for 20 plus years. And so they really have this niche. And so we're just hoping to capitalize on the value of the people that they put into it already. So that's our play there, Jim.
It sounds like a great project. So thanks for sharing that with us. I guess it's time to wrap up and say goodbye. It's been great talking to you, Jon, both before we got on, and then, I feel like we have a lot we can keep talking about
for sure
offline in the future, work together on some projects. I'm excited about your fund. And how can people get in touch with you? What's the best way for them to get involved in
sure. Yeah, sure. My website is www.blueeyedcapital.com. You can get access to all of our stuff there, and LinkedIn. I am extremely active on LinkedIn, so please come find me there. Shoot me a message, and we are open to everybody and anybody. And again, we are a people first organization, and so we only team and work with people that care about people, because that's what we are and that's who we are. So appreciate it, Jim, and look forward to both of us being successful.
All right. Thanks a lot. Take care.
Thank you.
Hey, thanks for having me on. If anybody else wants to find out more about what we're doing, please come to froggycompanies.com. Check out our 3 different business areas. We also have the Froggy Fund 1 that's now open for up to $18 million. We're going to be investing that $18 million across a diverse number of assets, cash flowing and ground up. And I'm really excited about this fund and really confident that we can outperform most of the other people out there in terms of what we invest in and how we do our due diligence and the type of partners we put together. So it's great talking to you, and see you next time.